Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Everest Group is a global reinsurance and specialty insurance company domiciled in Bermuda. Founded in New Jersey in 1973 and redomiciled in 2000, it rebranded from Everest Re to Everest Group in 2022.
The business has two segments. Reinsurance generates roughly $7.5 billion in premiums. Insurance adds about $4.5 billion. The insurance division is growing rapidly as Everest expands its specialty commercial book.
Reinsurance is the practice of insuring other insurers. When a primary carrier writes a large policy, it can cede risk to a reinsurer. Everest specializes in property catastrophe, casualty, and specialty lines globally.
The two key metrics for any reinsurer are the combined ratio, losses plus expenses as a percentage of earned premiums, and book value per share growth, which captures compounding underwriting profit and investment income over time.
Everest has a long track record of combined ratios below 100 in most underwriting years. The company is known for walking away from business it views as mispriced rather than chasing premium volume during soft market cycles.
The Bermuda domicile provides structural advantages. Tax and regulatory capital requirements are more favorable than in the US or UK, lowering Everest's effective cost of capital and supporting competitive pricing while maintaining strong returns on equity.
CEO Juan Andrade joined in 2019 from XL Catlin and Chubb. His primary initiative is building the insurance division, diversifying from reinsurance cycle exposure toward more consistent specialty commercial premium streams.
Renaissance Re and Arch Capital are the closest Bermuda-based peers. Both have similar structural advantages and underwriting discipline. Competition centers on how aggressively each pursues insurance growth while maintaining combined ratio targets.
Everest has raised its dividend for 24 consecutive years, paying about $7.40 annually. The payout is modest relative to earnings, reflecting capital retention to support premium growth in hard markets.
The balance sheet is strong. Investment income from a high-quality fixed income portfolio adds a predictable earnings component alongside underwriting profit. Combined, these two sources create a relatively resilient income stream.
Reinsurance is cyclical. Hard markets following catastrophe events improve pricing and loss ratios. Everest's underwriting discipline during soft markets preserves the balance sheet for opportunistic capacity deployment when conditions improve.
The insurance division expansion carries execution risk. Writing specialty commercial lines at scale requires careful actuarial discipline. How quickly Everest achieves target loss ratios in newer lines is a key metric to monitor.
For investors, Everest offers global reinsurance cycle exposure, a growing specialty insurance platform, a 24-year dividend streak, and management with clear strategic direction.
Book value per share growth and combined ratio tell you whether Everest is compounding capital efficiently, and those two numbers anchor every earnings conversation about this business.
That's the company chapter for Everest Group. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Everest Group just delivered a Q1 that reinsurance investors have been waiting on for 2 years. Adjusted EPS of $16.08 versus the street's $13.98, a 15% beat. Net income tripled to $653 million. Combined ratio came in at 91.2%, better than expected. Catastrophe losses dropped from $472 million to $130 year over year. This is Charged Alpha. Let's break it down.
Everest is a Bermuda-based global reinsurer and specialty insurer with a market cap of $13.6 billion. Reinsurers are insurance for the insurance industry. They take on catastrophe risk that regional carriers can't hold alone. Hurricanes, earthquakes, wildfires, terrorism, war, Everest underwrites it. Beta is 0.33, extremely defensive.
There are two earning engines. First is underwriting profit, premiums collected minus claims paid and expenses. Second is investment income on the float, billions in reserves invested in high-grade bonds. With rates elevated, that book throws off substantial income. The forward PE near 6 sounds shockingly cheap, but for reinsurance that's normal. The market discounts the multiple to compensate for catastrophe year volatility.
Revenue was $4.07 billion, down 4.6% and a slight miss versus the $4.31 billion consensus. Net premiums earned, the cleanest top-line metric for reinsurers, were $3.57 billion, down 7.2%. Premiums softened, reflecting discipline by management walking away from underpriced risk rather than chasing volume.
Profitability went the other way. Combined ratio came in at 91.2%, beating the 93.3 estimate by 210 basis points. Excluding legacy runoff, it was 89.3. Quick refresher. Under 100 means underwriting profit, over 100 means loss. 91.2 is strong for a quarter with real cat activity.
Catastrophe losses were $130 million pre-tax, down dramatically from $472 million a year ago. Of that $130, $58 million was a provision tied to the Iran conflict, the rest global weather events. Reinsurance treaty absorbed $90 million, global wholesale and specialty took $30. Cat contributed 3.6 points to the combined ratio versus a much heavier load last year.
Investment income was a major contributor. The fixed income portfolio yields 4.5% on a book basis, with average credit quality of AA- and asset duration around 3.5 years. That's a high-quality book benefiting from sustained higher rates. Float invested at 4.5% on a multi-billion-dollar portfolio drops meaningful operating income every quarter, regardless of underwriting volatility.
Net income was $653 million, or $16.21 per diluted share on a GAAP basis. That's up from $210 million, or $4.90 per share last year. Earnings more than tripled. Shareholder equity stands at $15.5 billion. Cash is $1.3 billion. Total debt is $3.6 billion, modest leverage for this balance sheet.
Capital return was aggressive. Everest repurchased $331 million in Q1 alone, following nearly $400 million in Q4 2025. Buybacks at 6 times forward earnings are exceptionally accretive. Every share retired boosts forward EPS meaningfully. Management is signaling the stock is mispriced versus book value and earnings power.
Analyst coverage is constructive but not euphoric. 4 buys, 3 holds, 0 sells. Average price target is 362.56 against a stock around 335, roughly 8% upside. Barclays recently raised its target. Wells Fargo cut to 332 with an equal weight rating, citing pricing trends and reserve risk.
Valuation is the headline. Forward PE near 6.3 on the 2026 estimate of 53.10. Sounds shockingly cheap, but that's normal for reinsurance. The sector trades at single-digit multiples because earnings swing dramatically in catastrophe-heavy years. A bad hurricane season can compress annual EPS 30 to 50%. Investors price that volatility into the multiple.
The bull thesis is that the market is over-discounting the volatility. With combined ratios in the low 90s on a normalized basis, plus a 4.5% fixed income book yield, underlying earnings power is more durable than the multiple suggests. A re-rating toward 8 or 9 times, closer to historical insurance averages, offers meaningful upside without earnings growth.
The bear thesis is that the multiple reflects real risks the bulls dismiss. Climate change makes catastrophe modeling harder. Long-tail casualty reserves could prove inadequate. The hard pricing cycle has been running for 2 years. Eventually pricing softens, combined ratios rise, and the next cat year arrives. The cheap multiple prices those tail risks.
Beta of 0.33 is the punchline. Everest barely correlates with the S&P. In a macro drawdown, recession, rate shocks, geopolitical sell-offs, Everest tends to hold up because earnings depend on underwriting cycles, not consumer spending. That low beta makes this a diversifier, not a return maximizer. People own it as ballast.
The bull case rests on 3 pillars. First, the hard pricing cycle. Reinsurance rates have been rising since 2023 because catastrophe losses forced capacity discipline across the industry. As long as that pricing holds into the mid-year renewals, combined ratios should stay in the low 90s, generating strong underwriting profits.
Second, investment income tailwind. Float invested at 4.5% on a duration of 3.5 years means the book gets repriced gradually as bonds mature into higher coupons. Even if the Fed cuts rates, the back book continues earning at elevated yields for years. That's a multi-year earnings tailwind already locked in by current portfolio composition.
Third, capital return at depressed valuation. $331 million in Q1 buybacks at 6 times forward earnings means each retired share is bought back at a steep discount to intrinsic value. Combined with the dividend, total capital return yield is meaningful for a defensive low-beta name. The buyback machine compounds book value per share even in flat earnings years.
The bear case starts with catastrophe frequency. Climate change is making weather extremes more common: wildfires, floods, severe convective storms. The LA wildfires in early 2025 remain a reference event for the industry. If the next several years average heavier cat loads than historical norms, the combined ratio could drift higher, and earnings power compresses regardless of pricing discipline.
Second concern is revenue. Net premiums earned fell 7.2% year over year. Management framed it as walking away from underpriced risk, which is a defensible posture. But if competitors aren't equally disciplined, the market share erosion could continue. Top-line shrinkage in a defensive name is a yellow flag, even when margins are improving.
Third is reserving uncertainty on long-tail casualty business. Workers' comp, professional liability, directors and officers, these claims can develop adversely for years after the policy is written. If social inflation drives jury awards higher than reserves anticipated, prior accident year reserves can be strengthened, which flows directly to current period earnings as adverse development.
Fourth, black swan events. Everest writes terrorism, cyber, and increasingly geopolitical risk, like the $58 million Iran conflict provision in this quarter. A major systemic event, coordinated cyber attack on financial infrastructure, large-scale regional war affecting multiple insured assets, could produce losses far outside historical models. That's the irreducible tail risk in any reinsurer.
Everest's peer group is global reinsurers and specialty insurers. Renaissance Re, ticker RNR, is the closest pure-play, Bermuda-based, catastrophe-focused. Markel, MKL, is a specialty insurance and investment hybrid run on a Berkshire-style philosophy. AIG and Chubb are larger, diversified primary insurers with reinsurance exposure but very different scale and mix.
Versus Renaissance Re, Everest is larger and more diversified across reinsurance and primary lines. R&R is concentrated in property catastrophe, higher beta to cat events both ways. In a benign cat year, R&R outperforms. In a heavy cat year, Everest's diversification cushions the blow. Both trade at single-digit forward multiples.
Markel bundles specialty insurance with a Berkshire-like investment portfolio. Its valuation methodology is closer to a holding company than a pure insurer. Everest is a cleaner earnings story. Combined ratio plus float yield drives the math. Pure-play reinsurance buyers prefer Everest. Compounding wrapper buyers prefer Markel.
Chubb and AIG are different animals. Primary commercial insurance with massive global distribution. Their combined ratios run in the high 80s to low 90s, similar to Everest, but growth depends on commercial pricing rather than reinsurance treaty renewals. They trade at higher multiples because primary insurance is viewed as less cat-exposed.
Options activity is muted versus high beta names. Beta of 0.33 means implied volatility on Everest options runs structurally lower than the S&P. Pre-earnings IV priced roughly a 2 to 3% move, and the actual reaction landed within that band. The beat didn't trigger a volatility surge because the market expected solid results once cat losses came in lighter.
Longer-dated options show modest call open interest at the 350 and 360 strikes for the back half, consistent with positioning for a re-rating toward the 362 target. Put activity is thin, low beta, and the buyback reduced demand for downside hedging. This isn't a stock that attracts heavy speculative options flow.
On insider activity, the dominant signal is the buyback. $330 million repurchased in Q1 2026, $397.5 million in Q4 2025, over 1.2 million shares, nearly 3% of float. That's an aggressive pace that shrinks the share count while management waits for multiple expansion.
Institutional ownership is high, typical for a mid-cap S&P insurer. Index funds, value funds, and insurance sector specialists dominate. No notable activist driving strategy. Management is executing a textbook capital return playbook. Right disciplined business, keep combined ratios low, buy back stock until the market catches up.
Bottom line on Everest? Solid quarter, disciplined underwriting, normalized cat losses tripling EPS. Forward PE of 6 is cheap on the surface, but typical for reinsurance. The fundamental case is intact.
If you want a low-beta defensive equity that compounds book value through pricing cycles and cat noise, Everest fits. Don't expect a moonshot. Expect steady value creation through underwriting profit and buybacks. Charged Alpha rates this a constructive hold for stability portfolios.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.